Hey there, welcome, visionary healthcare leaders. Today, we're going to dive into the critical financial structure that supports the transparency and compliance that you have in healthcare, the chart of accounts. This is something that I think is given very little emphasis and is really almost irresponsibly treated when you're setting up a bookkeeping system for your medical practice. Sometimes people do this without any forethought at all. So what's your biggest challenge with financial management in your practice? Share your thoughts below in the comments and tell me where you're tuning in from. So let's get right into this. First of all, let's talk about the chart of accounts. What I want you to do is to understand the importance and the function of a well-structured chart of accounts in medical practice. And what I want you to take away from this is that you need to know how to tailor a chart of accounts that'll provide a clearer financial picture, better insights that will help you improve not only your compliance, but your management decisions. So a well-structured chart of accounts is going to have all of the accounts where you're going to be recording your transactions, either in the income statement or the balance sheet. And the accounts that are there need to divide up those transactions in such a way that they are organized on these financial statements in a way that makes sense, that tells you a story about how well your practice is performing and what its financial condition is. The income statement is going to tell you how well you're performing, and the balance sheet is going to tell you what the financial condition of your business is. And your cash flow statement is going to tell you how well your cash is performing in your business. So this is why you need a good chart of accounts. If it's well structured, it's not only going to give you the income and the expenses on the income statement, the income and the expenses, but it's also going to give you what you would call a gross margin, which is going to give you the variable expenses separated from the fixed expenses effectively. It may not be 100% that way, but anything that's directly related to generating revenue is going to be a variable expense. So, how do you do that in a medical practice? You probably, if you have a chart of accounts right now, you probably haven't included that direct cost piece of it, which is maybe also called cost of goods sold. And typically, it's called cost of goods sold because typically it's used in a manufacturing environment, but it applies just as well to service-based businesses. And a medical practice is a service-based business. But you may also have products that you might be selling in your practice, which also would go into cost of goods sold, and that would be the cost of the products that you're selling. So if you want to integrate a good cost of or chart of accounts with QuickBooks Online. QuickBooks Online is up and coming as one, and it's already well established. I should say it's not necessarily up and coming, but we're moving from desktop to QuickBooks Online. In fact, just recently I have read news that QuickBooks or Intuit is actually getting rid of the desktop. They're not going to be continuing to update the desktop version, and they're moving everybody to online. And so the features of QuickBooks Online are becoming very robust and increasingly robust over time. They're constantly updating it. So anyway, sidebar there. you want to integrate this chart of accounts with your practice, and you're going to integrate it also with your practice management software, because your practice management software is taking care of the complex side of your finances by managing your revenue cycle. That you're going to be doing all your billing in there and tracking your billing and collecting and all of that stuff, tracking everything in that practice management software. So all the stuff that's going on in there, the complexity of the claims is not going to be in your bookkeeping system. It's too much for the bookkeeping system to handle. There's a lot going on there. So it makes sense to have this separate software called your practice management software, which has your billing software in it. And you want to have that separate. And then you want to take sort of the net numbers out of here and put them in here so you can be reporting your revenue. You're not necessarily going to be able to get your accounts receivable aging out of here because it's all in your practice management software. But you can generally see what's happening over here when you summarize the numbers and put them over here. So integrating that is really going to mean setting up a process for how you're going to get reports out of this software and make that your entries into your QuickBooks Online. So you want to take your existing systems and enhance your efficiency and your accuracy this way. So your revenue is going to be a summarized version of what's in your practice management software, and your expenses and your payables and all that are going to be what you're going to be keeping details of in your QuickBooks Online. And then you're going to be doing your financial reports out of QuickBooks Online. And anything that's related to the revenue, we'll leave that to the practice management software for managing your revenue, collections, and all of that kind of stuff. So you're not actually using all the features of QuickBooks Online, but any bookkeeping system that you have, you're not going to be using that piece of it, because in the medical field, you've got third-party billing, and third-party billing can get very complex, and that's why you have separate software for that. Okay, so what are the key components of an effective chart of accounts? So what I want to do here is to identify and define essential accounts that are specific to medical practices that should be included in your chart of accounts. So what you're going to take away here is a way to customize a chart of accounts that are going to reflect the unique kind of financial transactions that you have in healthcare. So anytime you're setting up a chart of accounts, this is what you need to do. And this is something that has to be done during the setup. Now, you can actually fix this after you've done it, but it means you're going to have to change your accounting procedures, and you're going to need to change the way you manage your bookkeeping and accounting, because this is fundamental. This is kind of like a foundational thing to your bookkeeping and accounting, because you're going to be structuring this a little bit differently. The chart of accounts is kind of like the bones of your structure. Without the bones being structured properly, the rest of it, everything else that goes on there, is going to be kind of distorted. And that's why this is so important. So the key components here are going to be, of course, you got your revenue, which is going to be what you're billing. And you're going to have your cost of goods sold, which is really the cost of your doctors. Basically, I mean, you need to look at each. I'm speaking generally here. So in some situations, there may be other variable type expenses that are related to your revenue that might go there as well. But essentially, I would say that's your doctor. That's what you're paying your doctors. They're getting paid for all the services that they do, and the service that they perform, that cost needs to go there. And then you're going to have what your general administrative costs, which is your office costs, anything that's related to running the business. And that's really effectively the structure. Now, the specific accounts that go in there are going to, we're going to talk about that in a second, but let me just also mention the balance sheet piece of this. Those accounts are going to need to be including things like your medical equipment. You're going to have depreciation schedules for that equipment. You're going to have, you know, you've got your cash, which is basically your bank accounts and your savings accounts. And so those are the basic. And you've got a credit card. And this is one thing that everybody misses. They want to record their credit card transactions when they pay off their credit card, and they just do it all in one entry. Don't do that, because it really messes things up in terms of being able to report how things are happening and being able to track costs with specific vendors and those kinds of things. You can't do that all in one transaction paying your credit card each month. You need to have a credit card account. There's a specific type of account that you'll find in QuickBooks Online that says credit cards, credit card type. This is essentially something you're going to treat exactly like you're going to treat your bank account. Every time you do a transaction in your credit card, it goes in this credit card account. This credit card account is something you're going to reconcile at the end of each month, the same way you do your bank accounts. This is important, very important, because you can quickly lose track of what's happening with your credit cards and what your expenditures are not getting into your books properly. Very, very important to do this properly. So you need to put a credit card account in there as a credit card type of account. It's not a bank account, it's a credit card account, because it's a payable, but you manage it the same way you do a bank account. Okay, that's it. And we would call that a current liability. It actually falls under that category of a current liability, because you still owe that money. You haven't actually put cash out for it yet, but you need to track those transactions. And then there's other current liabilities. I'm actually going out of order here, because if we start, there's cash, then there's current assets, and then there's long-term assets. Your current assets are anything that's going to be paid within 90 days. But essentially, technically, it's anything that's paid within a year. And then any asset that you're going to have for more than a year is a long-term liability. And long-term liabilities are capitalized, which means you will attach depreciation schedules to them. Current assets, you don't do that, because they're going to be fully utilized within a year, and so they will go on and off of the balance sheet within a year. Anything that's going to stay on the balance sheet for longer than a year is a long-term asset, and it's depreciated, it's capitalized. Anything that you make when you purchase a long-term asset, you are going to capitalize it. In other words, you're going to take that receipt for that particular purchase and you're going to capitalize it, which means you're going to put it as a long-term asset. You're not going to record it as an expense. You're going to record it as a long-term asset. And then you're going to create a depreciation schedule associated with that and start putting depreciation expenses in each month for that, for the life of that asset. And you have to determine what the life of that asset is going to be, depending on the type of asset that it is. So different types of assets have different lifespans. And so you have to figure out what the standard is. There are published standards for the different types of assets and how long, 3 years, 5 years, 10 years, whatever it is. Depends on the type of asset that it is. So that's your That's what goes on the asset side of your balance sheet. Then there's a liability side of your balance sheet, and that's where you're going to have your current liabilities, which are anything that's paid within a year. Any liability that's paid within a year, be paid off within a year, is a current liability. Now, of course, that's where your credit card's going, right? Your credit card's going to be included in there. Now, I'm going to mention another type that I didn't mention on the asset side because it really involves both sides. And that's if you have a medical group, you're going to have separate legal entities, and you're probably also going to have a parent company. Now, usually when you see the medical group, you usually see what's called an MSO, which is a management service organization. They're going to be a separate entity as well. So you're going to have these separate legal entities for all these practices and the management service organization. And you may be transferring money back and forth between these, maybe mostly between the service management service organization. But those are called intercompany transactions. And those transactions are going to be, you're going to have accounts that you're going to set up within that chart of accounts for what you owe, whatever entity that you transferred that money to. So all of these are part of a group. All these entities are part of a group, and you're transferring cash between these, or you're paying bills for the others. You're going to have intercompany transactions, which means you're going to have these due to and from accounts as current liabilities and current assets. So if you have another entity in the group that owes you, that you paid, bill for, or you transferred money to, they owe you. So that's considered a current asset, and that's going to be recorded in your chart of accounts as a current asset due from other entity. And if you have multiples, you're going to have, you want to have them separate. Some people will put due to from and put everything in there. It's much more difficult to reconcile that than it is to keep them separate. And it also helps you to manage better. You see, I come from more of a management perspective than a CPA perspective. CPAs are more compliance oriented, and they like to consolidate things like that. So they might put a due to / from account, and then you'll have everything go in there, due to and from. And I don't know whether they'll put it as an asset or a liability. I mean, I don't know what they put it as, but I'm specific. This is kind of like setting up a receivables account or a payables account from the other entity within your group. So you can track specifically what each entity in that group owes you and what you owe each entity. And when you do financial statements at the end of the month, of course, you're going to combine all these things so that they will cancel each other out and they don't show on your final consolidated financial statement. Unless there's an imbalance, one owes more than the other, or one, that kind of thing, then it's going to show up. There's going to a balance is going to show up there, which is appropriate. So that's those are some of your components there. Then there's the long-term liabilities, of course, which would be your bank loans or lines of credit that you don't have to pay within a year. Those would go in the long-term liabilities. And then you've got an equity section on the liability side of the balance sheet. The equity section is where your capital is. So any investments that were made in the business are going to be recorded as contributions under the equity section of the balance sheet. And your retained earnings, your profits, are going to be turned into retained earnings on your balance sheet at the end of the year. So at the end of each fiscal year, the net profits will be translated directly into your retained earnings. So each year you should see that grow as your profits grow. And that's part of your equity. So you take your contributions plus your retained earnings, and that's your equity. But you've also got shareholder distributions, which are going to reduce your equity. So that also goes over there. You may have investors that invest capital. Well, you're going to need to put that line items for those investments in there as well. Maybe shareholder contributions or whatever is appropriate for your entity type. I mean, there's different entities. There's LLCs, corporations, partnerships, whatever type it is. The names of the accounts can vary, but investors, you're going to need to record their investment in there, and that's part of the capital structure. And you don't have to pay those investors back until they cash out of the business. So whatever the value of their shares are when they cash out, that's what you would pay them. That's your income statement and your balance sheet. So all of that makes up your chart of accounts. So you need to design, what are the accounts going to be in these statements? That's what needs to go into your chart of accounts. That you need to decide on a strategic level. Decide what goes in there. Now it can be changed over time. You may not add an account until you need it later, but understand the structure so that you've got the basic structure there, and you can modify it over time if needed to further customize it. So oftentimes when you're first setting up, you're going to start with a template, which is going to give you the basics that you need there. And then as you see the need, you can add some of these other accounts, which brings me to another piece of this component for the chart of account, which is the numbers. There are a lot of places that don't even use the account numbers. That's okay. It's possible for you to do that, but I don't advise it. And the reason is because you need a strategy for these charts of accounts and how things are going to be structured on your financial statements and how you're going to order them so that they make sense on your financial statements. And also so that whoever's doing your bookkeeping, when they learn your chart of accounts, they can do things by number. And when they do things by number, it's a whole lot faster to use a keypad to type in the account number than it is to try to type out the account name when they're trying to record a transaction. It also, numbers, you would categorize number ranges by each type of account that I just talked to you about, like the income, the cost of goods sold, and the expenses, and the current assets and current liabilities, bank accounts, credit card. All of those are going to have number ranges that you're going to use. So, typically you'll have maybe a 5-digit or a 6-digit number that sometimes the digit, like the 6th digit, 5th digit, 4th digit, etc., will have a purpose. In other words, you may designate all bank accounts as 100,000 accounts, and then anything under 100,000 is a bank account, and then anything that is a current asset is 200,000 or 20,000, and then you would divide up within that according to the order that you need things, and you would leave gaps between those numbers to leave you room to add accounts later, because you're going to be more than likely adding accounts. Like, for instance, from the long-term liability side, 5 years down the road, you may borrow money and get a bank loan. Well, you're going to need an account number to assign to that for the balance sheet, because you're going to give a specific account, that loan, a line item on your balance sheet as a long-term liability. So you're going to need to have an account number available for that so that you can enter that on your balance sheet. So that's why you leave gaps and ranges in that. So when you're designing your chart of accounts, you need to keep that in mind as well. And you can use, if you get templates, oftentimes they will give you those guidelines. They already have those numbers generally assigned if you get a good, well-designed template chart of accounts. And by the way, you know, I have a template chart of accounts for medical practices. And if you want a copy of that, I'll give it to you for free. And, you know, just schedule a free consultation, and I'll be happy to, you know, we'll talk about that later, but as a free consultation, I'll give you a free chart of accounts template. And then you can begin to repair your current chart of accounts if you already have one, or if you're in the process of designing a system, you'll have the chart of accounts that you can set it up with. A template that'll give you a starting point for all of these things. So those are the key components of an effective chart of accounts. I know it sounds like a lot of information, but this is the core of what I was talking about here today. This can also, you can also use this to help improve your revenue cycle management. So you can use the features of QuickBooks to manage your patient billing, payments, and insurance reimbursements more effectively. Now, this is when it comes to integrating with your practice management software and how sophisticated you want to be with this. It could be, but you could keep it very, very simple in QuickBooks and do all of the management in your practice management software, in your billing software, which is probably the most efficient way to do that, because if the more you try to put into QuickBooks, the more you're going to have to divide this information up in ways and get it entered in over here so that you can manage it over here. It gives you a much bigger picture in QuickBooks, but you're going to get into more detail in your practice management software. So you have to decide how much do you want to get into this? How much do you want to end up managing it? And is it going to be easier for you to just manage it in there in your billing, if you're doing your billing, or is it going to be easier to manage it over here? If you're outsourcing your billing, you might want to get more information into your QuickBooks because you want to be able to manage what's going on. All right. If you're just advocating your billing to an outsourced billing company, you're probably losing a lot of money because they're not as motivated to collect everything. And there's a big portion. I mean, from what I have seen, you can take 40% of your claims that are billed and just write them off, which leads me to another piece of the chart of accounts here that we want to put in here. And you're going to want to put this in your QuickBooks, no matter how you handle the billing side. You're going to be recording, what you bill. And then you want to have what's called a provision for contractual adjustments and an allowance for contractual adjustments. The provision is going to go on the income statement. So you're going to take what you billed and you're going to subtract, they call this a contra income account. You're going to subtract the provision. You're not going to collect this, so you subtract it. And then the net income is what your actual income is going to be. This is going to be your gross income less what you're writing off effectively, which is called a provision for contractual adjustments. And then you're going to have your net income, what you expect to collect. And then on the balance sheet side, you also want to record that. So you're going to have an account over here on your balance sheet called an allowance for contractual adjustments. So whatever you put in your provision is being moved over here to reduce the accounts receivable. So it's a contra accounts receivable account that reduces your accounts receivable balance to show what you actually expect to collect. These are accounts that are specific to the medical field, because you have third-party billing. You've got contracts directly with insurance companies that they say these are what they're going to pay you for these specific procedures. So what you're going to have to do is keep a historical record of what you collect on average from your billing. And that's going to inform you what percentage you need to reduce your billing to what you think you actually are going to get paid. And that is going to be reflected on your accounts receivable and your income as well. It's just basically reducing it all. The reason why you want to do this, the reason why you want to put these numbers in here, because you need to manage that. You want to collect as much as possible. You want to reduce that allowance as much as possible. However you can do that. This is something that is highly neglected in the medical industry and needs to be done more effectively, especially with small practices. When you get into a medical group, they're going to pay more attention to this, because if you're hiring a management service organization to manage and help you become more profitable, obviously this is one of the biggest areas for potential improvement of the bottom line. So those are accounts that would go in the chart of accounts. You also have, provision for bad debt, which means, if you're collecting from patients, you may bill patients, and that means you may not always collect from them. How much of that on average do you not collect? You need to make an allowance for that. So you need to provide for that on the income statement and put an allowance on the receivable side as well, so that you know that you're writing it off ahead of time, and that way it doesn't all hit you at one time at the end of the year or whatever. It spreads it out over time, because on average what you're going to be able to actually collect. So revenue cycle management, that's a piece that you can get. That's a big piece you can get into. It's a big subject, because it involves how your billing goes, how you manage your payment system, how you manage your contractual arrangements with the insurance companies, what kind of insurance you take, all of those kinds of things. How do you handle collecting payments from patients for their piece of responsibility? Do you go back to patients when the insurance company doesn't pay? Those kinds of things. So that all is going to inform how you structure your chart of accounts on the revenue side, and how you manage your revenue cycle. And of course, that's going to involve more activity and more management in the practice management software, which is outside of the scope of the bookkeeping and accounting over here, because this is such a big area for third-party payers. That's a complex area. So anyway, to kind of bring this all to a close here, you want to apply this by simply understanding what kinds of accounts are appropriate in your system. Don't do what I've seen in some of these some of these medical groups, where they take each insurance company and they create an income line item. Aetna, Cigna, income. And you've got this big long list of all of the insurance companies. And I've also seen deposits as an income line. That's not right. That's not the case. You don't do that. That's inappropriate. It muddies up your chart of accounts, and it makes it really extremely difficult to do good financial reporting. And it's the same thing with the expense side. Don't put Amazon on there as an expense item, or put employee reimbursements as an expense item. Those employee reimbursements are expense items that are in different categories. They may be travel expenses, they may be office expenses, and you reimburse them. You need to categorize them the expense, not the fact that it was reimbursed to an employee. So those are the kinds of things that expenses go in the expense column, not vendor names. I've seen this in multiple places. That's why I mention it, because it seems to be something that people like to do for some reason. There are appropriate categories. That's why you get a template, and that'll take you down the right road. So as you apply this, I highly recommend getting a template. Wherever you get it from, get some kind of a template and use that to begin to design your chart of accounts. And if you need help with that, we're here for that. We can help you with that. So you want to embrace these financial structural changes, because it will revolutionize your practice's efficiency and your financial clarity. So if you want personalized guidance on this, please reach out. I will even help you customize your chart of accounts if you need that. And we can also help you integrate it with your QuickBooks and meet your specific needs. We do a health check, which involves, this is part of what the health check is evaluating your chart of accounts. But there are a lot of other issues in terms of getting a good, accurate set of books. And that's what we do when we do a health check. So we have what's called a QBO health check, and we will do that for you, and then it'll get your books cleaned up. And if you're doing things properly going forward, you'll have accurate financial statements. So with that said, let's close with a quick prayer. Lord, bless these healthcare leaders with wisdom to manage their resources wisely. Grant them the clarity and the insight that they need to steward their finances and their practices with integrity and with a sense of purpose to fulfill their purpose that you've given them in helping people with their health. Ensure that their practices thrive and for the benefit of all that they serve, not just as a profit activity, but this is an important social arena, keeping people healthy and keeping them alive. And we just thank you, Lord, for these doctors that do these things. And in Christ